Awesome, thank you. So my name is Stacy Dozie. I'm a Strategic Alliance Manager here at Avalara. I want to thank Crestwood and Amber for having us and help facilitate this, and thank all of you for taking time out of your day to hear about the really exciting world of sales tax. So we want to talk about a couple of things today. The title, as you can see, is Sales Tax Complexities and what South Dakota v. Wayfair means to you. And so I'm hoping that most of you have heard of South Dakota v. Wayfair, but if not, we'll cover that as well. So really quickly, just some of the things we're going to cover today by means of an agenda. We want to talk about challenges of compliance, why sales tax is so challenging and what that means. We'll also, again, touch on Wayfair and what that is. We'll talk about how automation helps, and then, of course, we want to talk to you and give you the option to download an ebook at the end, the Sales and Use Tax Compliance for Dummies. Something really good if you guys are looking for a way to get to bed at night, or if you're really interested in sales tax, you can read it. It's a short read. It's pretty good, actually. So we're going to start with the pop quiz just to wake you guys up. I know that you're all muted, so I'll kind of just let you guys mull this on your own as I bring this up. We want to talk about some different areas of taxability and just kind of see what your thoughts are on this, and I'll explain some of this. So first, bagels in New York. So the difference between a sliced and a whole bagel, I don't know if any of you guys know, so I'll give you a minute to think about this. There is a tax difference. As you can see, a sliced bagel is taxable, whereas a whole bagel is exempt. And the reason here is it's the difference in the state of New York anyway between a prepared food and a non-prepared food being taxable and non-taxable. Takeout beverages in Colorado, this is really interesting. This is takeout beverages only. You'll notice that the cup is exempt, whereas the straws and lids are taxable. And that's because, as you can imagine, a cup is really required when you want to take a beverage out of a restaurant, but the lids and the straws are not. So they're going to say that you can then pay tax on those to Colorado. Candy bars is an interesting thing. We have candy bars listed here in Indiana. I live in Minnesota, and this rule also applies here. I did test this. Some of these are taxable and some are not. And so if you can kind of think about this on what's happening here with what's exempt and what's not, it really has to do to some of the contents and what makes it more of what they would consider a food item versus a candy, and the content of gluten or wheat in those products. So there is a difference in candy bars. So this is kind of as how we want to step into what are the compliances to sales tax. And as you can imagine by some of those examples, there are a lot of differences on a state-by-state basis and even product-by-product that we'll touch on that makes sales tax complex. So let's go into this. What are some of the complexities? So first of all, understanding nexus, and we'll get into that. That's going to be a big session, or a big topic on today's section, is understanding nexus, but also keeping in tune and step with the rules and how often they're changing and what states are changing and what their cadence is for change. And then obviously being in compliance with all the requirements to take care of those taxes and what that takes your team to be compliant, how many hours they're spending on being compliant. And we're going to talk about what this whole compliance thing means. The other big piece of this is that it's really not optional. There is no reward for your organization to be taking care of taxes and doing it correctly. But on the flip side, there are actually fines and penalties and really high risks if you don't do it properly. And so, you need to have somebody in your organization oftentimes who's thinking about this and really doing their due diligence on just sales tax. And if you don't, that burden of proof is on you, and there can be, like I said, a lot of fines and penalties and interest. So that compliance complexity is amplified by the risk that you may incur as well. So let's talk about some numbers before we get into the Wayfair thing. And I think this is kind of interesting because this is based on some studies that were done back in 2017, but you'll see that on average, 47% of state revenue is coming from transactional sales tax. That is a very large dollar amount that states are looking to get into their revenue stream to spend on different things like roads and programs and education. And so you can see the next one on the right-hand side that states are losing a lot of money based on uncollected e-commerce sales. So when they're expecting to get almost 50% of their revenue from transactional sales tax, and they're losing money because of e-commerce sales, you can imagine that states have been screaming, saying, wait a second, I want my money. Imagine back when you used to do a lot of your shopping in your own state or your own city, and you'd go down to the store and you'd buy your toilet paper and your toothpaste, and you'd pay tax to your local jurisdictions in your state. And now people are buying things on Amazon.com or Etsy or wherever, and they're having them shipped right to their door. And so states are losing that money because of those online sales. And so that brings the introduction into the South Dakota v. what? So again, I hope that many of you have heard of this. I want to give you a brief overview of what this is. So like I mentioned, a lot of states were really reliant on getting this income into their state. They were looking at large revenue coming in, and they've been losing it over the years to online sales. And so over the last couple of years, there's been some discussion in our court system, and on June 21st of last year, the Supreme Court finally did hand down a ruling in the case of South Dakota v. Wayfair. So essentially, South Dakota went after Wayfair and said, we think that you should pay sales tax to us. You should be collecting and remitting sales tax when you're shipping into our state. And Wayfair fought that all the way up to the Supreme Court. And the Supreme Court said, they ruled in favor of South Dakota, which actually overturned a previous ruling, which was Quill Corporation v. the state of North Dakota back in 1992. That ruling essentially said, if you have a physical presence in a state, you are then required to collect and remit tax. South Dakota v. Wayfair kind of overturned that, and they said, now there's this idea of economic nexus. You now have an economic presence in the state of South Dakota, and therefore we think that you have an obligation to register, collect, and remit. So that's kind of the background on South Dakota v. Wayfair. So let's talk about who's affected and what those impacts are. Really, this is not just for online sellers. This is not just e-commerce stores. This is really for anybody who's selling remote. If you take phone orders and you're shipping into a neighboring state or even across the country, this could affect you. If you have a catalog, anything where you could be selling remotely into another state, this could affect your business. The impact really is so big on the number of companies that now are having to look at when are they now becoming at risk of having economic nexus in these states. South Dakota was just one of them, and as you can imagine, and this slide is a little outdated, it says 15 states have already declared new laws since the ruling, but I believe the number now is, I think, like 34 states now have taken on economic nexus rulings. Some of them are not exactly in effect yet. So the effective dates have kind of been trickling over the time period since June of last year. Some of them became in effect in January of this year. Some are still TBD. Some are kind of throughout the year. But many, many states now are saying, wait a second, you also have economic nexus. I want some economic laws in my state saying that you may reach an economic threshold in my state. So again, the most powerful and impactful thing here is that the whole idea of having a physical presence is not the only indicator now of having a nexus in a state. So again, just to recap, it added this whole idea of economic nexus, and we're going to talk more about nexus in a minute. But the whole South Dakota v. Wayfair ruling really talks about adding economic nexus, and it's not just South Dakota. We'll talk about that in just a second, but it is other states as well. A couple of other things. This did not change anything about what products are taxable, who's exempt, or anything like that. This really is just a matter of when you have nexus in a state. That's the only difference that this ruling really had, is the idea of when you do or don't have nexus in a state. So I want to show you this map. We try to keep this updated as things are changing. I know it's a really busy map, and at the end I'll give you a link to our website where you can see this on an ongoing basis. But this map gives you an idea of the number of states that now have economic nexus laws on their books. The thing that I want to draw your attention to, and I don't know the demographics of who's on the call, what type of businesses you have, but one of the things that's very, very important, you'll notice on the right-hand side, 18 states in orange, so you'll see Tennessee, New York, Maine, Vermont. Those are states that say when we establish economic nexus thresholds, meaning if you sell more than $100,000 into our state, you now have economic nexus. That's an example of a revenue threshold. These states in orange are saying this is not just taxable sales, these are all sales. So for any wholesalers that are out there and saying, I really don't have to worry about sales tax, that's not true. Many of these states have revenue thresholds that include all sales. And if you meet that threshold, you're still required to register, collect, and remit, even if it's $0. So you would register and have to file a $0 return. And if you don't, again, that burden is on you as a company to prove to that state that you don't have to collect tax. You have to make sure you have all your exemption certificates, and all of that stuff has to be in order. So you still may have filing filing needs in some of these states, even though you're a wholesaler. So that's something to think about if that fits your business mold. So let's talk a little bit more about tax in specific. And if anybody has questions about the Wayfair piece, please feel free to put it in the chat. But many people, when they think about sales tax, think about rates. What is the tax rate in your city, state jurisdiction? And so I need to collect this rate and charge it across these products. But essentially, there are a lot of other things that are below the iceberg that really add to the pieces of sales tax complexity. And this is what makes it complex. We have to talk about nexus. We have to talk about product taxability, jurisdictional assignments, exemption certificates, state and local filing, and then, of course, heaven forbid, if there's an audit. So we're going to touch on all of these really briefly. We talked about nexus already, right? So nexus is this idea that you now have an obligation with the state that you need to register, collect, and remit in that state. And the old standard, like I said, used to be physical presence. But there are a lot of other things that could give you nexus in a state. Physical presence, by the way, is still an indicator. That didn't go away. If you have a brick and mortar building in a state, you likely have nexus in that state. The economic nexus, meaning you now have revenue thresholds, whether it's dollar amounts or certain number of transactions or both, that's an economic nexus trigger. But additionally, there are other things in some states that could cause you to have nexus, and this is equally as important for companies to know. Having field sales reps in some states, or sending your team to a trade show in some states could trigger nexus in that state. And the thing to think about is that person or people in your office who are doing tax maybe on the side, who are managing tax rates in your ERP, are they up to speed on what every state in the country is doing to cause, to say this is what triggers nexus and here's all the taxability rules in my state? So this is really the nexus challenge. And where do you have nexus and what is that reason? Is it economic? Is it based on a physical location? Is it based on, 1099 employees, for example, could cause nexus in some states? So understanding where you have nexus is one of the first steps. Then we get to product taxability. We talked about this on that first slide as well, understanding what products are taxable in every different state. States like to make this very complex, it seems. They don't like to have the same rules. So every state could have a different spin on what they consider to be taxable or not taxable. One of the latest things I think that people have seen over the years is software, downloadable software, movies. That has changed state by state over the last couple of years. But you can see some examples here on things that are taxable or non-taxable in different states. And the thing to remember here is that these are constantly changing. Every state can be different. And how exactly are you going to manage this in your ERP system? I mean, if you think about some of these rules, maybe this doesn't apply to your business, but how would you actually manage this in your ERP? It gets very, very complex. Then we move on to jurisdictional assignments. And what that really means is, are you charging the exact rate that you should be charging for an address? Most ERP systems and most companies, if they're doing it manually, are using a zip code, a 5-digit zip code. And a zip code really does not align with your taxing jurisdictions. Zip codes were used by the U.S. Postal Service and not by the taxing jurisdictions. So I want to show you an example here of an area in Denver. This is the Colorado area. And what this shows you is the different zip codes you can see are broken out. The white borders are the different zip codes. And then you can see all the color coding that's showing you the different tax rates in a given zip code. So if you're in 80237, it looks like you're pretty good at just using the zip code for your tax rate. However, if you're in the Greenwood Village area in the 80111 zip code, you have tax rates that can range in the orange from 7.72% to the dark green, which is 4.35%. And that's a 3% swing that could be across the street. And making sure that you understand that you're using the exact right location to get the right tax rate. Otherwise, you're charging the wrong rate potentially. So then we want to, and this just is a pop down that kind of shows you, what could make up those different taxes. And you've got anything from city taxes, county taxes, a football district tax, and so on. So another piece of compliance complexities is really managing exemption certificates. And a lot of times people don't think of this as a complexity, but it really is. because oftentimes manufacturers or wholesalers are the first ones to be audit targets, because that onus is still on you to prove why you didn't collect the sales tax. And so that means, do you have all of your exemption certificates? Are they valid? Did they expire? In some states they actually expire, and others they don't. Is that company name still valid, or did you go through an acquisition where now that exemption certificate is no longer valid because that company was acquired? These are all things to think about in making sure that you have that paperwork in hand and ready should an audit occur. State and local filing, that's a big problem for people who are managing taxes. And then if you think about this from one state or two states, if you're working, if you're living in Illinois or in Wisconsin, for example, you might have one or two states that you're doing taxes for. But now think, if this economic nexus thing is going to cause your business to expand into multiple states, that means now you've got to manage filing calendars for all of these states. When do I need to file? Is it monthly? Is it quarterly? Is it annually? Do I need to prepay? How do I manage these tax notices? All of that can be very complex and very time consuming for somebody in your organization. And then finally, like I said, heaven forbid if an audit comes into play, are you ready? Do you have access to that data? Can you accurately get the reports that you need? Do you have access to those exemption certificates? All of these things are really part of the complexities of sales tax. So let's take a little bit of a break. I'll read this to you. In Massachusetts, a clothing item costing up to $175 is exempt from sales tax. However, if an item costs $175.01 or above, it's subject to sales tax. Is it true or false? And of course, this is true. It's almost too weird not to be. The thing that's interesting about this is some of these states that do have tax on clothing, for example, they may vary. Minnesota, there's no tax on clothes. Some might tax it all the way. Some may tax it like this. The other thing is there are states that will say only the amount above the threshold is taxable. Anything, $175 and lower, for example, in some states might be non-taxable, and the amount over would be taxable, versus other states where it's once you go over that threshold, the entire amount is taxable. And again, that just talks about how complex tax can be on a state-by-state basis. So let's just take a minute to talk about how automation can help your business. And some of the main things here is, how do you mitigate your risk and gain accuracy and also improve your efficiencies within your organization? Some of this is kind of what I'm going to call my numbers portion of the presentation. I'm going to give you a lot of data, but I think these numbers speak volumes, and just to kind of help you understand what people are seeing. So first of all, 98% of companies are actively involved in one or more nexus creating activity. So think about that list of things I gave you. It used to be, do you have a physical presence? And that was really easy. Then it's, do you have remote employees? Have you attended trade shows? Now, have you met economic thresholds by selling into a state at a certain revenue and or transaction volume? And it says 98% of companies here actively are involved in some of these nexus creating activities, and they may not know it. 94% of companies have misconceptions about how nexus is created. And again, it's very complex with all these states having different rules. So that's not really a surprising number. And then here is just another interesting fact. 39 hours per month is kind of what a lot of companies are spending in becoming tax compliant. Again, researching rates, making sure their ERP is up to date, getting their product taxability right, all of that kind of stuff. So that's kind of some averages, again, from that Wakefield research study. Just a quick quote here: any effort spent on sales and use tax compliance and related activities are non-revenue generating. Again, we understand that you guys all have a core competency in your business, and sales tax is not it. And so anything that you're doing is really taking away from the revenue generating activities of your business. This next set of slides I find interesting. So it says here 69% of accounting and finance professionals find this the most confusing part of their job. I want to couple this with the next slide because I think this is rather funny, and I hope some of you guys get a chuckle out of this. So 48% of those same professionals said that they think the Rubik's Cube would be easier to master. And I, for one, never ever was able to do that unless I removed the stickers. 42% of people would rather get a root canal. Again, I've done that. I don't know that I would say that, but this is actually live research that was done, by a number of accounting and finance professionals. So I find these numbers kind of funny. This is an interesting number, and it's going to lead into kind of thinking about what your business is doing. So this was an Aberdeen Group study that was done talking about what companies are spending to manage sales and use tax within their company. So think in your own organization, the number of people that touch sales tax, the amount of time that they're spending researching rates, updating their ERP, filing returns, getting that paperwork ready, responding to sales tax notices, all of that. And so you can kind of see the ranges here for small businesses. They're saying on average it's $63,000 for small businesses each year to manage their sales and use tax. So this is as you're doing it today, probably manually or with your ERP. And it can go all the way up for very large businesses, almost $400,000. So that's a lot to spend to manage sales and use tax compliance. So now again, couple this with the next slide. 75% of companies felt that auditors were likely to find a mistake. So that's really huge risk for your company. If you're spending on the low end, $63,000 to manage your sales tax in-house, and if you're 75% sure that an auditor would find a mistake, that can be very, very large. I mean, that's a lot of money to spend with a really high risk value. And on top of that, 56% of companies found that one single audit could cost them over $50,000. And this is in the time that their employees are spending preparing, and of course the back tax payments, penalties, and interest. So the interesting thing about this is per audit. Auditors are getting really tricky these days. They're sharing company information. They might be finding other audit targets based on the audit they're in. So if you're in a similar industry to a neighboring company where they had, and I'm using air quotes, a successful audit, because the states would see a successful audit where they regain a lot of money. So if they say, oh, this was a very successful audit, who are their competitors or in this, who's in the same industry here, or who is their vendor that didn't charge tax on this that should have? And so they're being very creative in how they find audit targets. And so you could very easily become an audit target. And once you get audited once by a state, you're likely to be back in that cycle within 3 years. So this can really add up over time. So I want to talk a little bit about our solution. I'd be remiss if I didn't tell you why I was here. So we do at Avalara have a suite of products that can help you to manage sales tax compliance. The first thing I want to point out is that we are a cloud-based solution. We also have a team of researchers that are constantly in contact with state and local governments, researching what are the new rates, are the boundaries changing, what are the taxation rules on products and services, and making sure that our cloud product is always up to date. It's not a new product that you have to download and put in your system. The cloud, with it being up there, all of that data is automatically being input with the right dates so that all of that information is up there and ready when you need it. AvaTax is our tax calculation piece that integrates with your ERP or your POS system. We do connect into over 700 products right now. So think of any product that you could use for billing or invoicing. We will connect to that. And when you create a transaction, we're going to look at that transaction. It's going to submit it up to your profile in the cloud. And it's going to say, do you have Nexus in this state? Yes or no. Is this customer taxable or exempt, excuse me? Yes or no. Is this product taxable? Yes or no. And at what rate? And it's going to return that rate to you in about 0.4 of a second. So it's going to be very seamless, but we're going to evaluate all of those rules and give you the tax rates that we have in our tax tables. Now, in conjunction with that, we do have a product called Cert Capture. This will help you to manage exemption certificates. So we can send requests to customers, they can fill them out, and we can store them for easy retrieval if you need to. Also, there's reporting that can help to tell you which exemption certificates might be expiring soon, so you can grab new ones. This can also interact with AvaTax so that, like I said, in that decision tree where it says, is this customer exempt or not, we can look in your ERP or we can look at Cert Capture to determine whether or not that customer is exempt from sales tax. And then finally, we do have a returns and filing piece. So if the returns and filing in your states gets to be too cumbersome, we do have a service available for that where we can give you all of the data, tell you what your tax liability is, and you can tie that out. And once you approve it, you can just hit approve. We'll sweep those funds and we'll do all of the returns filing for you as well as manage all of those tax notices. These 3 products in conjunction make a really great suite of products, but additionally, they can be used independently. You don't have to use all of these together. You can use any one of them independently. So I really want to quickly just talk about this iceberg and talk about how our solution can help deal with each of these tax complexities. So first with Nexus, once you're all set up on AvaTax, it's as easy as just a one-click jurisdiction add-on. So if you start selling into a new state, or all of a sudden you now have economic nexus in South Dakota based on the thresholds, you simply go into those nexus settings and click on South Dakota and you're done. All of the other rules are already in our system. We already know what they are. We know what your items are. So you simply add the jurisdiction with one click. Product taxability. Again, you'd have to map your products the first time so we know what you're selling and what your business is, but we maintain all of the rules for products on a state-by-state basis. So we manage all of that on an ongoing basis for what products are taxed and at what rate. Jurisdictional assignment, this is a really great thing. Our tool gives you a free address validation. So one of the first things that we're going to do is we're going to validate the address that was entered. For any of you who are shipping product, this becomes very valuable as well. It may help with misships, but we're going to make sure that we get a rooftop location. We're going to do a latitude, longitude on that address to get a rooftop location to make sure that you're charging the exact right rate for that location every time. We do, like I said, we do manage exemption certificates. You can use that completely independently if you're a wholesaler and you just need to manage exemption certificates, or you can use it in conjunction with AvaTax as well. Again, we talked about the state and local prep filing. We do the returns piece where we can take care of all of that for you. And then finally, audit readiness. We have a fabulous portal for customers to use with a lot of reporting. You can even give, for example, your auditor a temporary login, and they can go retrieve their own exemption certificates, and you can have that timeout. So you can free up your people from having to dig paperwork for people. You can make the auditors do their own work. So you'll be able to find all of that information very quickly and very easily for your auditors. Finally, as we wrap up, I want to just tell you a little bit about us as a company. We were founded in 2004. We're based in Seattle, Washington, but we do have people all over the country. We currently have over 20,000 active customers, and I believe at last I checked, I mean, our renewal rate is somewhere around 97 or 98%, because much like automating payroll, which I'm assuming a lot of you have moved to over the last 10 or 20 years, once people start automating this, they realize that this is not a task that they want their employees to worry about. We do have over 700 pre-built connectors. And then there's a bunch of other information here in terms of transactional data that just talks to kind of the volume that we process, because we do take pride in the number of customers that we service and the speed at which we can do that and the accuracy. So there's some of this as numbers here for any of you who might be interested. So finally, just a couple of other things, and if you guys have questions ready, we'll address those in a second. There is a URL link here to the Sales and Use Tax Compliance for Dummies. This is a book that we co-authored with the Wiley brand. So like I said, it's a quick read, but you might find some value in it. We'll also send this to you, I believe, in an email link so that you can go and download the Sales and Use Tax for Dummies. My contact information is here. I'll come back to this slide, but I want to move one more slide real quick and just talk about some resources on Wayfair. I'm happy to answer some questions. I have a couple of other people with me as well on the call that can answer questions. But there is a lot of information out there on Wayfair. There is a long URL here that you can write down if you'd like. But if you Google Avalara and Wayfair, you'll probably find a lot of this. One of the really cool things is this economic nexus guide in the middle. I know it's hard to read. This is just a screenshot. But this is actually a listing of every state and if they have an economic nexus law and what those thresholds are. So again, it can be a revenue and or a transaction level or both. And every state is pretty much giving different thresholds. So it could be $100,000 or 200 transactions. It could be $250,000 and 100 transactions. But this guide will tell you on a state-by-state basis what those thresholds are and some additional information. So I would encourage you to go find this. We can get you this link as well. But a lot of information on our website related to South Dakota v. Wayfair. So I'm going to pop back here if you guys want to jot this down, and I'm going to open it up to questions. And I don't know, I think, Amber, you're the one who will be seeing those, correct?
Yep. We've got one so far. And this one says, can you talk more about those states that are originate versus those that are destination taxes versus those that are both, like California?
Actually, Rick, you're on the call. Is that something that you could answer easily, Rick?
I was just dropping off for another meeting I got to get on right now. The question again was?
Origin versus destination-based states.
Well, some of the states are origin-based and some are destination-based. The system will automatically take that in consideration and knows all the rules that apply based on those and apply, because there's also hybrid. And we know based on the origin's address and the destination's address. And as Stacy had mentioned, we will convert those addresses and validate them and convert them into latitude and longitude and pinpoint the appropriate jurisdiction. So hopefully that answered your question.
Awesome. Thank you, Rick. If you have to go. And Amber, if you have the contact person for that, if you send it to me, we have more detailed information, and we have different documents that we can send based on that. And I honestly don't know as much about that as I maybe should, other than I know that we handle it. But if there's specific information they're looking for, we can certainly get that answer out.
Okay, great. They say thanks, so that probably did answer some of that question. We have one more that just rolled in that says, can you talk a little bit about the use tax and the non-inventory items that are subject to it?
Yeah, use tax is a different animal, right? And I'm sure whoever's asking probably knows that. So we do have several of our connectors. So again, our connectors connect to different products like Dynamics GP that have use tax capabilities in them. But really what it is it's a designation and reporting capability for the most part, because as a tool, the tool doesn't know what products you would be buying for resale that you may be consuming. So it's kind of when you get the invoice, it allows you to designate a portion of the invoice as something that's being used internally versus something that's being resold. So it's more used as a designation, like I said, and a reporting tool so that you can get that information out for reporting purposes. And again, if somebody has specific questions, we can get more specific answers on it. I think the second part of that was about non-inventory items. Is that I'm assuming that's kind of the same thing, because it's what portion of taxable or non-taxable products they're consuming that now they have to pay use tax. I'm assuming that's all part of the same question.
Thanks for watching. To learn more about our products, visit www.crestwood.com. Hope to see you there soon.